Hey everybody, welcome back to the channel. Today we're talking about PayPal, ticker symbol PYPL. I'm on their investor relations website, as you can see on the screen right now. And PayPal is one of those companies and one of those stocks that has really taken a beating over the last couple of years. In fact, if we go back to July 2021, the stock price was nearly $300 a share. Today it's trading at $57 a share, so that is a 72% drop in stock price, and it's down about 40% year over year right now. So a lot of retail investors have been looking and talking about this stock. So in this video, we're going to be doing a stock analysis and determine what the valuation of PayPal is currently right now. We're also going to take a look at analyst estimates on what they think the company is going to do over the next few years. And we're going to be looking at a financial history of this company, determine where they've been and possibly kind of where they're going as well. PayPal currently has 400 million active consumer accounts. They have 35 million active merchant accounts. They've processed $1.4 trillion of total payment volume over the last 12 months. They've also processed 24 billion payment transactions over the last 12 months as well. Guidance for 2023, management is estimating non-GAAP EPS growth of 20%, non-GAAP EPS of $4.95, non-GAAP operating margin expansion of over 100 basis points, and free cash flow of around $5 billion. Currently, their GAAP EPS is about $3.50. If we look at historical numbers for PayPal, I typically like to go back 10 years. Unfortunately, we can't really do that with PayPal. They haven't been around as a public company for more than 10 years. So I'm just going back the last several years to look at the data there. So you can see in this column here, this is enterprise value of the company. You can see back in 2015, it was around $40 billion. And it's certainly grown over the years. In fact, it got to about $270 billion of enterprise value in 2020, but you can see it quickly has fallen off since then. Now, keep in mind that enterprise value is a little different than market cap. It basically just looks at market cap and then adds in any debt and subtracts any cash from total market cap to get to enterprise value. Now, these big five numbers over here, that is looking on a per share basis. So for example, this is sales per share. You can see in 2015, they were about $7.56 on a sales per share basis. That grew all the way to about $26.01 here in the last trailing 12 months. So in this particular case, over the last 3 years, the company has grown sales per share 12% per year. Over the last 5 years, 15% per year. Over the last 7 years, 16% per year. So you can see the growth has certainly slowed down over the last couple of years. However, they still are producing double-digit CAGR growth. Now, as far as earnings per share grows, it's kind of a similar situation, where it's gone from 18 to 16 to even worse, around 1%. Now, free cash flow per share, that has certainly taken a hit overall. Over the last 7 years, they've grown 7% per year, but over the last 3 years, they've actually had negative 10% growth. Book value per share, I think this was interesting to me. The fact that I thought with this company growing as much as it has been, that the book value per share would be better than what it's showing. It has grown from $11.25 back in 2015 to about $18 here today, but that is only a 6% book value per share growth per year. I would have thought that would have been in the certainly 10 to 15% range at least, if not in line kind of where sales per share and EPS is around 16 to 18%. So book value, that is a bit concerning. That is not growing nearly as fast as sales per share and earnings per share overall. Now, our return on invested capital for this company, pretty consistent over the last 7 years, 11%, over 5, 12, over 3 is around 11%. Now, when I'm looking at a balance sheet, I want to make sure that the company does not have a lot of debt on the balance sheet. I also want to make sure that it has plenty of cash, enough current assets to cover any current liabilities, and that's what these ratios are here. So for example, EBIT over net debt, that's just looking at how many years is it going to take for this company to pay off their net debt based on their operating earnings. So for example, right now it's going to take them about 3.6 years to pay off their net debt. I like to see it under 3, so that's not too bad. But it is over the threshold I like to see. Now, as far as the debt to equity ratio, you can see it's averaged about 32% over the last 7 years. Last 5, it's been 48. Last 3 is 53. I like to see that under 75% at least. Under 50% is really good. So being around 53% average the last 3 years and 57% today, that is pretty good. That kind of tells me their debt is not out of hand by any means. Their current ratio right now is a 1.3, which has been very consistent over the last 7 years. So they have plenty of current assets to cover their current liabilities. Now, as far as a multiple for this company, what the market has been willing to pay. Now, if you look at enterprise value over EBIT or enterprise value over operating earnings, over the last 7 years, on average, it's been 43. Last 5 years, 48. Last 3 years, 28. So what that tells me is the market has been willing to pay a premium for this company because really their sales, their earnings, and even free cash flow up until the last couple of years has really grown at well over 20% rate, and the return on invested capital has been really solid overall. So the market has been willing to pay a high multiple, certainly, but it's dropped down to about 13 here today. As far as margins go, gross margins right now are around 41%. They have averaged 46%, 44%, and 44%. And their EBIT, which is the operating earnings margins, they've been really consistent, 16% across the board over the last 7 years. So now let's take a look at what analysts think this company is going to grow over the next 5 years. So this column right here shows where earnings, revenue, all these different financial metrics were at the end of 2022. And here are the estimates from analysts going out the next 5 years. So from a revenue standpoint, analysts believe the company is going to grow about 10% per year over the next 5 years. So going from roughly $27 billion last year to around $29 billion this year to about $45 billion in 2027. Net income is supposed to grow around 11% per year, operating income around 31%, free cash flow 9%, cash from operations 11%, and earnings per share around 26%. So they definitely do think that the company is going to grow at a substantial rate over the next 5 years. Keep in mind that last year they did have some lower numbers than they've had in the past. So that is a lower base than kind of what we've seen here over the last several years. So let's take a look at this first valuation model right here. And this is a margin of safety calculator. Basically what I'm doing here is looking at earnings per share, projecting it out over the next 5 years. So I have an EPS of 3.5, growth around 15% per year for EPS. I have a rate of around a 3. And what I do is I come up with a target buy price of around $70 per share. Currently, the stock is trading at 57, so that is almost a 20% margin of safety. The next model we're going to be taking a look at here is my discounted operating earnings model. What I'm doing here is I'm projecting out sales over the next several years, which is pretty consistent with what analysts think the company is going to do. So I think they're going to be around $29 billion this year, and they're going to grow to $32 billion in 2024, then $36 billion, $40 billion, and then $45 billion in 2027. So that is a 10% growth on the top line over the next several years. Next up, what I do is I take a look at operating margins. Last year, they came in at 14.7%. This year, I'm projecting at 16.5%. And then the years after that, I think they're going to be in around the 17% operating margin range, which is fairly consistent with what we've seen from the company over the last several years. Next up, we want to take a look at the multiple, and certainly the market has been willing to pay a high multiple for this company, but I do think that the sales, operating earnings, even though they're going to be really good, is going to be a slowdown from what we've seen in the past, but I still do give this company a 20 multiple if they can grow about 14% operating earnings per year, which puts an intrinsic value of around $70 roughly today. The next valuation template we're going to be taking a look at here is a 10 cap valuation model. Essentially what I'm doing here is looking at owners' earnings of a company and then dividing that by total shares outstanding to come with a 10 cap. So essentially I want to buy this company at 10 times earnings or 10 times free cash flow. So I'm coming up with around a $5 billion average free cash flow for this company. That's what management is expecting to get for 2023. So based on that, I get a 10 cap valuation of $54. So that is slightly below what the price of the stock is currently trading at today. The next valuation template we're going to be taking a look at here is the payback time calculator. What it's doing is calculating free cash flow out over the next 10 years. And basically we want to buy this company at a payback time of 8 years or less. If you think about it, on average, markets have been willing to pay about a 16 multiple or 16 payback time for companies historically. So they've been willing to buy into a company and get their money back in 16 years. If we can cut that in half and have an 8, that tells us that we can hopefully get a faster return from the stock price, if that makes sense. So based on that, I come with a payback time of $63. Currently, the stock is trading at 57, so it does look like it's undervalued from there. So if we quickly look at a valuation summary for PayPal, again, my operating earnings model came up with a fair value of $69 for this company. I would consider a buy price of being around $48 at 30% margin of safety. Payback time has a buy price of $63. 10 cap has $54, and the margin of safety calculator has it at $70. So 2 out of the valuation templates or models do say it's a buy right now. Next up, let's take a look at a return on investment for this stock. This is based on my operating earnings model that we saw earlier. So based on this table right here, if you were to buy the stock at $69, you could expect around a 10% return per year. Whereas if you bought the stock, say at $46, you could expect around a 20% return on investment per year over the next several years. But that's based on the assumptions that we went over earlier. You should always do your own research and have your own valuation templates that you use. If you don't have any valuation templates, I do offer them on my Patreon, which I'll put a link down below. I'll teach you on how to use my operating earnings model and other templates as well if you don't know how to use it currently. Thanks for sticking all the way through this video. If you haven't already, please go ahead and like the video. If you like this kind of content, go ahead and subscribe to the channel. I'll catch you guys on the other side. Take care and God bless.